Thanks very much for that, Em and Sherry, for rounding up the action in this part of the world, which doesn't look pretty at all at the start of the week. Thomas Hayes is Chairman, Managing Member at Great Hill Capital, joining us live from New York with his thoughts. You're pretty much in the heart of all the action that we witnessed in Friday's session. Thomas, good to have you. What's your own read? Because, you know, Will made the important point that we've given up all our gains for the markets come September in the countdown to the all-important Fed meeting at the end of the month. What does that mean for market positioning now?
Well, I think the markets needed a reason to consolidate, Tanvir, and Jay Powell gave them that reason on Friday. You know, Friday was really a continuation of the jawboning strategy, which has worked so well to bring down demand, to reduce demand and consumption. The playbook has been to talk hawkish and act dovish since the beginning, since March. And that's a perfect continuation of the process. I know everyone feels like, no, this is different. But if you look at their words versus their actions, there's nothing new here. And they've been very, very successful with the strategy. Two things you have to keep in mind regarding Jackson Hole. Number one is if they wanted to crush inflation, they could do it overnight by raising the Fed funds rate to 6%. They haven't done that. And there's a reason that they haven't done that. Obviously, they don't want to completely crush demand. They want to try to orchestrate a soft landing. But number two is debt servicing. And no one really talks about that. With debt to GDP at 125%, every 1% increase in rates is an additional $285 billion added to the U.S. deficit. So that's why you're seeing a lot of talk to bring down inflation expectations. They always say they're more concerned about long-term inflation expectations than actual inflation in the short term, because some of it is supply chain, some of it is commodities which have rolled over, some of it is the lagged effect. And if you look at 5-year break-evens, they're at 2.73% right now. So they've been able to successfully anchor those expectations largely through talk, albeit the 75 basis point hikes have been aggressive. But moderate considering the level of inflation we've had.
Sure, I agree with you, and I know that that's been the narrative, that they're going to talk hawkish and act dovish. But do you not think that the language was a bit too hawkish in terms of saying that we're going to use tools forcefully to bring down inflation? And so, in a way, he's preparing the market for a 75 basis points hike and not relenting henceforth as well, till inflation cools off to below 2%, because the sense in the market was that the current strategy would help bring inflation down to 4-5%. We're really not down to 2%.
Well, here's a little history, and this came from Philadelphia Fed President Harker on Thursday. He said, we've had 86 rate hikes since 1983. 75 were under 50 basis points. He said that 75 basis points is unusual and that 50 basis points is still very substantial. The other thing is Fed President from Kansas City, Esther George, said that the lags from policy are long and variable. So what they're basically saying, the implication is that they want to see the lagged effect of these last two 75 basis point hikes before getting too aggressive with another 75 basis points or quantitative tightening. Now, I know Jay Powell jawbones a strong message, but he also indicated that he'd be dependent on the data. And I think, and I've said publicly before Friday, the more important data points, more important than Jackson Hole, will be the jobs report on Friday, which is expected to be strong. But more than that is the CPI and PPI. And we may have gotten a preview on those inflation numbers with the Fed's most favored metric, which is core PCE, which came in lower than expectations on Friday. So things are pointing in the right direction. And I think that 50 basis points is still substantial, and that is still on the table for September and will be data dependent despite the hawkish talk.
Okay, Tom, I want to play a little bit of a counter narrative with you when it does come to what the Fed chair is doing. Maybe he's just saying to the markets with a very short statement that we're trying to play chicken with him in terms of the positioning when it came to the Treasury markets, that we are going to do this. He was trying to be explicit in that respect. And even if we are believing that perhaps he's going to be acting a little bit dovish, there's also the fact that we are going to see this QT coming on and basically at the fastest pace in history in terms of that wind down, and that's an unknown, and that could have potentially significant implications just on its own in terms of liquidity, because we like talking liquidity. So isn't there just the case to be made that he's just trying to explain to the markets, this is what's going to happen, we're going to be just focusing and honing in on inflation, and that means we're going to have the rate setting perhaps at a 4% terminal rate. But then you've also got to factor in that there could be that downside coming through because of the QT that no one is accurately pricing.
Yeah, so we saw the first mistake in 2018 when they nearly threw the market off the cliff on Christmas Eve, and they had to step in. Look, you can look at their words and you can look at their actions. So far, we know that it's going to accelerate in September, but they're only at 1/3 of what they had scheduled to do in terms of quantitative tightening by this point in the schedule. So 2/3 is incomplete at this point. You also saw that quantitative easing is like the Hotel California. You can check in, but you can never leave. The ECB already has a quantitative easing facility for the periphery, as hedge funds are the most short that they've been Italian bonds since 2008. So as much as they've talked tight and they've talked hawkish, the ECB, they're already back in doing QE under a different name for the periphery bonds. So I think that Jay Powell got a clear lesson when he first came in as chair, that things break when you go too aggressive on quantitative tightening. And I think the data from the CPI and PPI may prove to be helpful in terms of maybe being a little more flexible on the quantitative tightening schedule moving forward, as he has been in the first few months looking backward.
I wish we had more time to talk about all of these inflation implications, particularly when it comes to the fact that this could be transitory in terms of the softness we are seeing because of gasoline. But I wanted to move on to some of your calls because obviously everyone watching is going to want those. And one was interesting. You're bullish Meta right now on a valuation perspective, but aren't you worried that realistically, considering the advertising revenue, considering that now they've just realised perhaps we don't push too hard on the actual metaverse component and perhaps focus on our core component, that there could be a little bit of execution risk moving forward in the next 12?
Look, Facebook or Meta is the greatest advertising machine that has ever been created in the history of mankind. It will never be replicated on that scale. Yes, TikTok will have some shares, but you know, Mark Zuckerberg has a history. He'll either buy it or copy it, and you know, he's doing already with Instagram Reels. He's having some success. The other thing to keep in mind: this is a political election year in the United States, so I think estimates may be too low on that ad spend because political spend is less correlated to the economy than general commerce advertising. So that's number one. You never want to bet against Mark Zuckerberg. It's trading at 15.5 times next year's earnings. Expectations have been taken down tremendously. Even with all the fear about the metaverse spend, they're still going to grow at 7.5% a year for the next 5 years. My guess is it's going to be a lot more because either the metaverse is going to get traction or they're going to reduce the spend down dramatically and open up the spigots for cash flow. So, you know, it's very infrequent that you can buy such a high quality business at such a significant discount due to exogenous events with the market dislocation, with the tech sell-off this year. And not only are we seeing that in the US, but we're seeing it around the world, particularly in China.
China is your call, right? that's the other call that you have with the Crane Shares China ETF.
Yeah, no question. Well, I think you want China internet exposure. One of our largest positions is Alibaba. We were a little bit early on that, but we've been successful at adding consistently on weakness. We think that's going to be a major performance contributor in the next 6 to 18 months. What you're seeing, and you guys know better than anyone else, is every single day there's fiscal or monetary policy or regulatory easing. It's been a complete reversal of the last 12 months, and it's going to take a little time to rebuild that confidence, to see that in the economy. I mean, just at M2 money supply growth was up 12% the last read. That is huge money supply growth. So as the zero COVID becomes less pronounced and you don't see the shutdowns as aggressive in the major cities and that economy reopens, we're already seeing it in the web traffic for Alibaba, et cetera. And then looking forward, you know, McKinsey was out with a report that the China public cloud market is going to grow 3x over the next between now and 2025. Well, Alibaba is the major player in that, 36.7% market share. They are going to be the greatest beneficiaries of that exponential growth. This is one of those examples that exogenous events cause a high quality business with a moat to be on sale, and that's when you want to step in.
Yeah, and I may sound like a broken record, but even, you know, any business has a price, right? So Alibaba and the likes, of course, have fallen enough to create a compelling case here. Thomas, thank you very much for joining us late outside. We appreciate your thoughts.